Silver didn't randomly explode. It printed around $106 an ounce, depending on the feed. Then it didn't cool off. It accelerated. And that is not a quirky commodity headline. That is a structural signal. Because silver is not just a metal. Silver is a lie detector. When the world is calm, silver behaves like an industrial input. When the world is stressed, it behaves like a stress test for the monetary system itself. And when the stack of paper promises becomes heavier than the physical reality underneath, silver stops whispering, it reprices. Here's the first hard number. Global debt, public and private, has been hovering around $251 trillion, more than 235% of world GDP. In the United States, total federal debt has been around $38.5 trillion. Now stop and think. A system built on that level of leverage doesn't break in a day. It breaks in stages. And what you just watched in silver is not the beginning. It's the moment the crack became visible. In the next few minutes, I'm going to do three things, fast. First, I'll give you a four-stage pattern that repeats across empires and modern economies like physics. Second, I'll prove it with three historical case studies you can verify by year and policy decision. Third, I'll apply the same pattern to the present and show you why triple-digit silver isn't crazy. It's consistent. And near the end, I'll give you one question, that tells you whether you're positioned safely for what comes next, without telling you to buy anything, without hype, and without fake certainty. Ready? Lock in. Stage one is the setup. A currency becomes credible. People save in it. Contracts are written in it. The system has a constraint. Gold, silver, fiscal discipline, or at least the appearance of restraint. Trust is the foundation. Stage two is expansion. The system discovers leverage. War, welfare, bailouts, political promises. It doesn't matter which story you prefer. The result is the same. Liabilities grow faster than real productive surplus. Money and credit expand to cover the gap. This phase feels like progress because it is the present borrowing from the future. Stage three is crisis. Reality pushes back. Interest costs compound. External shocks hit. Supply breaks. Trade deficits widen. Confidence starts leaking. Authorities respond with management, messaging, emergency measures, interventions, sometimes controls. The system becomes reactive, then frantic. Stage four is the outcome. Confidence snaps. People flee from promises to things, not because they're greedy, but because they're rational. Scarce monetary commodities reprice upward to absorb excess paper claims. And after that repricing, the political and financial order restructures. That's the pattern. Now let's prove it. Quickly, 3 times. First proof, Rome. Stage one, setup. The Roman denarius was a trusted silver coin across a vast empire. It paid soldiers, enabled trade, and anchored taxation. Money wasn't just money, it was Rome's nervous system. Stage two, expansion. Costs rose, armies expanded, borders stretched, political stability became expensive. Rome found the easiest way to fund itself, alter the coin, reduce silver content, mix in base metals, mint more coins from the same metal stock. It wasn't framed as debasement, it was framed as necessity. But the mechanism was simple, more claims on the same goods. Stage three, crisis. Merchants adjusted, prices rose, soldiers demanded more pay, trust in the coin deteriorated. The state responded like large states do when money fails. More issuance, more coercion, more control. Eventually, money stopped communicating value. Every transaction became a negotiation. Stage four, outcome. The monetary system fractured. Barter returned. Payments in kind spread. Reforms arrived. Late attempts at stabilization, price edicts, enforcement. But edicts can't manufacture trust. Rome didn't weaken because of one villain. It weakened because the unit that connected the economy lost credibility. Template confirmed. Check. Second proof, Weimar Germany. Stage one, setup. Before World War I, Germany's mark operated in a gold standard world. Expectations were anchored. International trade had a reference point. Trust existed. Stage two, expansion. War arrives. Costs explode. Governments borrow and print because honest taxation is politically lethal. Germany finances the war heavily through debt and monetary expansion, expecting victory to settle accounts. Then defeat arrives, and the Treaty of Versailles imposes reparations that must be met in hard terms. The state needs real external value it cannot print, so it prints more paper to chase it. Stage three, crisis. The squeeze becomes a loop. More marks issued means the mark buys less. Exchange rates slide, imports become unaffordable. Wages chase prices. The government prints to meet wages and obligations. The feedback loop feeds itself. Stage four, outcome. Hyperinflation destroys the unit of account. People flee to anything that can't be printed. Foreign currency, goods, metals, property, inventories. And when money collapses, Society doesn't adapt smoothly, it fractures. A currency collapse is a trust collapse. Mechanism confirmed, verified. Third proof, the United States, 1971 to 1980. Stage 1, setup, Bretton Woods. The dollar is the global reserve instrument with an implied anchor. Foreign governments can redeem for gold. Credibility is baked in. Stage 2, expansion. Fiscal commitments grow. Vietnam, Great Society, deficits. Dollars flow abroad faster than U.S. gold reserves can justify. Foreign governments notice. Redemption pressure rises. Then the boundary is hit. In August 1971, Nixon suspends dollar convertibility into gold. The anchor is cut. Stage 3, crisis. The 1970s deliver stagflation. Oil shocks and supply constraints hit. Monetary expansion continues. Inflation becomes visible, then embedded. Trust erodes. Stage 4, outcome. Capital flees into hard assets. Gold and silver surge. Speculation amplified the 1980 silver spike? Yes, but that's the point. Speculation doesn't create the vulnerability, it exploits it. Public demand for hard value is the fuel. Financial leverage is the spark. Restoring credibility required Volcker's rate shock and a painful recession. Pattern confirmed. Undeniable. Now you've seen the same 4 stages in 3 radically different systems. So let's do the autopsy on the present. No ideology, just structure. Stage 1, setup, was the post-2008 regime. After the global financial crisis, central banks cut rates, bought assets, and signaled liquidity as a permanent feature. Fiscal authorities ran larger deficits. Markets were trained, explicitly and implicitly, to believe that every serious drawdown would be met with intervention. That created confidence, short term, but it also created behavior, long term. It taught the world that leverage was safe because pain would be socialized. Setup complete. Check. Stage 2, expansion, arrived at a scale most people still can't emotionally process. Global debt sits in the hundreds of trillions. U.S. federal debt climbed into the high 30s, and the inflation signal proved the system's sensitivity. CPI hit 9, 1% year over year in June 2022, the highest in 4 decades. Those are not trivia facts. They are stage 2 fingerprints, more claims, more debt service, more fragility. Expansion confirmed, verified. Now, stage 3, crisis or loss of control. In a modern system, loss of control doesn't have to look like riots. It looks like constraints. It looks like interest becoming a political problem. It looks like markets punishing the wrong sentence from a policymaker. It looks like currency volatility spiking on headlines. It looks like consumer confidence sinking even while official narratives insist everything is fine. And it looks like silver doing something it only does when pressure is real. It gaps. In January 2026, silver pushed through 90, then through 100. And then it started printing numbers that used to sound impossible in a single month, highs above 110, even above 115 on some sessions, while major reporting described speculative momentum colliding with tight physical supply and depleted inventories. So here's the uncomfortable question. If silver can do that now, what else is mispriced? Hold that thought. Because silver is small compared to the oceans of money trying to hedge. A little flow hits a tiny doorway. That's why the move looks like a malfunction. Not enough metal at the posted price, too many paper claims, and too many traders forced to cover at once. Small market, big stress. Because this is where most videos lose you. So let's do a pattern interrupt and make this practical. If you only remember one thing from this entire breakdown, make it this. Silver doesn't need the world to end to explode. It only needs the paper system to wobble. And you can measure the wobble. You don't need insider info, you need signals. Here are 3 signals that tend to light up right before metals go vertical. And you can track them without becoming a full-time trader. Signal 1, the currency narrative breaks. When headlines shift from strong dollar to dollar sliding, when markets start pricing interventions, or when confidence in policy consistency gets questioned, that's a permission slip for hard assets to reprice. Not because the dollar is dead, but because trust is being repriced in real time. Signal 2, the bond market stops being boring. You don't have to memorize yields, just watch direction and volatility. When debt is huge, bond moves become political events. And when politics starts steering bonds, the system loses smooth control. That is stage 3 in modern clothing. Signal 3, the physical bottleneck shows itself. Supply response is not instant. Mining output doesn't jump because price spiked this week. Refining capacity is real. Recycling is not a magic tap. And if inventories in major vaulting hubs are already drawn down after years of deficits, price can gap just to locate metal. That's why impossible numbers print in a hurry. The posted price is chasing a physical reality that can't be created with a keystroke. Now, if you're thinking, okay, so what happens next? Good, because that question is the open loop that keeps you alive in regime shifts. In phase change markets, you often get this sequence. A a vertical move, then a violent pullback that scares late buyers, then another move that makes the pullback look small in hindsight. Not always, but often. So if you're watching silver and trying to decide whether you missed it, you're asking the wrong question. The right question is, are we in a regime where these repricings can happen repeatedly? Because if the answer is yes, then the opportunity is not one candle. The opportunity is understanding the machine so you don't get emotionally whiplashed every time volatility spikes. And that brings us back to the number everyone is repeating. 106. 55. Why does a number like that matter? Because markets are psychological battlegrounds. Triple digits isn't just math, it's a narrative threshold. It flips mainstream attention. It forces risk managers to recheck limits. It triggers media coverage. It invites both momentum and backlash. So when you see silver go through that zone, you're not just watching a commodity. You're watching the system broadcast a message. The old range is no longer credible. Now stage 4, the outcome. And this is where people get fooled because they stare at silver and think the story is silver. No, silver is the messenger. The story is credibility. Gold is mostly monetary. Silver is monetary and industrial. That matters because the world is not only trying to hedge monetary instability, it's also trying to electrify everything. Electronics, solar, data infrastructure. Silver is embedded in industrial demand, so silver sits on 2 pressure points at once, the money pressure and the supply pressure. When monetary trust weakens, investors reach for scarce stores of value. When industrial demand is strong and inventories are tight, physical availability becomes the constraint. When both happen together, silver doesn't drift, it jumps. So what just broke? What broke is the old equilibrium, where paper claims could grow faster than reality without forcing a repricing event. And now we have to address the comment section question. Is this manipulation? Here's the sober answer. Markets are always influenced by big players, incentives, and positioning, but manipulation is not the root cause of a multi-year regime shift. Manipulation happens inside the system. The system determines the direction. If you build a world on expanding debt, permanent interventions, and fragile supply chains, eventually you get a moment where the chart stops behaving politely. That moment is not a surprise. It is the bill coming due. Now, I promised you a simple way to tell the difference between a healthy correction and a regime-ending reversal. Here it is. A healthy correction is emotional, fast, scary, headline-driven. It shakes out weak hands. But the structural pressure doesn't disappear. A regime-ending reversal requires something bigger. Constraints must loosen, debt stress must shrink, policy credibility must strengthen, physical bottlenecks must ease. The system needs to regain breathing room. So ask yourself, did the machine get healthier, or did the machine just get louder? If debt is still massive, policy is still constrained, trust is still fragile, and physical supply is still tight, then a pullback is often just a reset of momentum, not a return to the old world. Now let me make this personal. Most people aren't asking, why did silver move? They're secretly asking, what does this mean for me? So here is the question I promised. It's the simplest way to map your risk in a crisis regime. If the next 6 months include higher volatility, sudden policy shifts, and a confidence shock, what part of your life depends entirely on someone else keeping a promise? Sit with that, because someone else's promise includes more than you think. It includes leverage. It includes assets priced for perfect stability. It includes income streams that vanish when credit tightens. It includes being forced to sell when liquidity dries up. The goal is not to predict the exact top in silver. The goal is to not be structurally fragile when the regime changes. And here's the mistake that destroys people. They want one answer. Tell me what to buy. Tell me the next number. Tell me the date. The system doesn't work like that. A pattern gives you stages, not timestamps. So instead of pretending certainty, here's a survival framework. First, stop chasing candles. In a stage 4 environment, the most expensive behavior is emotional buying after a vertical move. Volatility punishes impatience. Second, reduce fragility. Reduce unnecessary debt. Keep a liquidity buffer. Avoid positions that can force you into a margin call or a panic sale. You don't need to be rich to do this. You need discipline. Third, diversify across regimes. In calm regimes, growth assets dominate. In crisis regimes, non-correlated exposures matter. That doesn't mean going all in on anything. It means you're not betting your entire future on one macro outcome. Fourth, understand what you actually own. Paper exposure and real exposure are not always the same, especially in tight commodity markets. Know the structure, the custody, the liquidity, and the counterparty risk. Fifth, stop letting the news cycle set your beliefs. Headlines change every hour. The pattern doesn't. The pattern only cares about claims versus reality. Now, before we close, I'm going to dismantle 3 excuses that always appear right before the cycle bites hardest. Excuse 1, this time is different because America is exceptional. Exceptionalism doesn't erase arithmetic. If interest costs rise faster than real surplus, choice is narrow. The narrative can delay adjustment, but it can't cancel it. Excuse 2. Modern economics has tools now. Tools don't remove trade-offs. They relocate them. Stabilize today by expanding claims, and you increase tomorrow's fragility. Excuse 3. Technology will save us. Technology can raise productivity, but it cannot retroactively delete accumulated liabilities. It cannot make debt service disappear. It cannot make supply deficits vanish overnight. And it cannot prevent institutions from choosing politically easy solutions under pressure. Technology can make the pie bigger, but if the number of claims on the pie grows faster, the slices still shrink. So here's the final warning. Silver at triple digits is not a weird moment. It is a phase change. And phase changes have one defining feature. They make the future feel like it's arriving faster than your explanations can keep up. So don't argue with the chart. Don't argue with the debt. Don't argue with the incentives. Study the mechanism. Map your exposures. Build resilience. Because the next stage of this pattern, after the first shock, is always more volatility, more narrative warfare, more policy improvisation, and more repricing of anything that can't be printed. And Silver just told you, in the bluntest language markets have, that the gap between paper claims and physical reality has become too large to hide. If you want to understand how the machine was built and what happens in the next stage, subscribe now. Because in the next video, we're going to trace the plumbing, how the post-2008 regime trained markets to depend on intervention, why that creates inevitable stress fractures, and what to watch when the system tries to regain control. Don't just watch prices, watch the pattern, because the pattern tells you what happens next.